Nikhil Vora is joining in right now to take some questions with regards to the HUL open offer. He's Managing Director at IDFC Securities. Nikhil, good morning. Good to have you here. What is your first reading of the open offer?
I think it's a brilliant move from Unilever. It's a move which is beneficial and positive for all the stakeholders of Unilever in India. I'm very, very enthused with this move, and I would sense that this will continue the re-rating of an already re-rated sector in India, which is consumers. So I'm very positive on the way this entire transaction is getting structured out. I obviously believe that there are 2 or 3 key implications to look at from this open offer. One is the fact that this is an aggressive, huge open offer from Unilever and clearly signals its intent of remaining a dominant force in Indian consumer space over the next few years. For the minority shareholders in Unilever, I think it's an excellent opportunity to monetize their investments into Hindustan Unilever. Second is to look at what's happening with the Indian consumer space. The fact is that with this open offer from Unilever, my sense is that it will re-rate the entire consumer pack and move liquidity away from Unilever to the ITCs and United Spirits and Godrej Consumers, and then the entire secondary trades like Jyoti Labs and so on. Third is that it also means that a lot of the consumer names and possibly a lot of pharma names, where you've seen global parent holding just about a relevant majority, like the Nestle and Colgate of the world, will potentially see a significant move from the parent company, given that most of the parent guys are extremely strong on cash, and the dividend yield on most of the Indian companies, even today, are closer to 2.5–3%. I think you will start to see pretty much re-rated consumer pharma space for shareholders in Hindustan Lever. I would think it's a extremely good opportune time to monetize the investments into the company.
So your advice to holders of HUL stock is would be to tender?
Oh, precisely. I think, frankly, the businesses are not going to change in a disproportionate manner. The fact is that, and I don't know the number, but let's say the market cap has changed within one day of close to $10 billion or upwards. The business has not. And the business is not really going to change in a differential manner because of higher shareholding from Unilever. So Unilever at 51% and Unilever at 75% will not really make this business very different from what it is today. I think for shareholders, it's an excellent time to look at monetizing their investments, and I would surely look at a lot of brilliant shareholders looking at exiting from this open offer.
Yeah, because we had an investor earlier in the morning who was saying that he'd hold on. He thinks that for a transaction this size, if they want to buy 22% more stock, they'd have to do more than 600 rupees. Nikhil, how do you think about that?
Let me guarantee you that no investor, and I'm not talking about any specific investor right now, but no investor, be it large or small, ever feels or would go on record saying that this is an excellent price for them to exit. So I think it will be interesting to watch out what really happens once the open offer is launched and completed. My sense is that most of the institutional shareholders will tender in this open offer.
Why shouldn't one look at this as just a one-off? And why should this deal put the spotlight on other consumer names, and hence the analysis that they should re-rate other stocks in the space as well? I mean, why should this go that way? Why can't this be just a one-off?
It's a fair point to say that it could very well be a one-off. So I have no arguments with that. My argument is that let's assume this is one-off. Then the fact is that Unilever in India will incrementally not be an investable stock, given that liquidity in the stock will become a bare minimum. And also the fact that all of us know that at least in any Indian company, 5 to 10% of shareholding is pretty much dominant shareholding. So Unilever will cease to be an active stock as you move forward. The consumer business will still remain fairly aggressive structurally on a high growth. So there will be investment opportunities in consumers. And, given the fact that there will be a fair bit of liquidity which will be available into stocks like United Spirits or ITC or Godrej Consumers, and then down to the second layer of stocks, including Nestle and Colgate of the world, I think there will be a lot of cash or money chasing these consumer names. So irrespective of an open offer trigger, which is by default event calendar, which is unpredictable, I think the businesses will become more valuable than what they were yesterday.
Yeah. Any other names come to mind which might see which might potentially see similar action?
So what you've seen right now is players like GSK and Unilever, which are fundamentally European entities who've done this. So a quick name which obviously comes to mind is Nestle. And the fact is that Nestle in India is possibly among the very, very few Nestle entities globally which are listed entities. Look at American names, Colgate. India is, I think, after Japan, the only other listed entity in Colgate globally. So these are ostensible targets. It could happen anywhere else. It could happen into pharma space also. It could happen in consumers. But I think these could be very likely candidates.
These could be likely candidates. Does this change? I mean, somebody was pointing out that so far growth expectations were moderate from the sector and they were getting even more moderate. Does the foreign parents' reaffirmation through this move change anything in terms of your expectation for demand in the consumer space, or it doesn't?
I think it doesn't. The fact is that the irony is that all the investors that we look at, irrespective of their tenure, at best are a 1, 2, 3, 4, 5-year play. That's a time horizon for most investors. Whereas for corporates and companies, the way they look at businesses are over a 50 and 100-year period. So clearly that time spans are very different. I don't think operationally it really changes the color of the business. Unilever in India at 52% shareholding and a Unilever in India at 75% shareholding does not really alter the face of Unilever operating in India or the businesses that they get into India and so on. So my sense is that operationally things don't really change disproportionately. Growth rates, while they are robust, they are clearly at a lower rate than what they were for the last couple of years. And I don't see that changing in a disproportionately soon manner. But the fact is that this business will get re-rated. This is a structural opportunity in India. You are going through some pangs of slowdown, not really strong enough, but you are clearly getting into a moderate growth period. But structurally, this is a business which should grow at 1.5 times GDP over a period of time. So I'm still enthused with the overall direction of growth. These are event triggers, and by default, larger companies need a larger shareholding in India. They have to pay a larger premium. So you're just looking at a natural trend following.
Nikhil, thanks very much for your time. Great to have you with us here.